Here's a screenshot from my Fidelity account a year ago showing $4.8 million and I lost it. Actually, intraday, I got up to like $5.2 million. I took a screenshot and I couldn't find it. So we're going to go with 4.8 because that's what I can prove. So this is what went wrong. Back in April of 2024, I was on Twitter and I saw people talking about a stock called MSTR, MicroStrategy. They're a company that buys Bitcoin and they issue debt and issue shares and buy more Bitcoin. I like Bitcoin, so I thought, sure, I'll buy this. And then I saw other people buying what are called call options, a leveraged bet on the future of this stock where your returns can be even greater than the stock returns itself. So I decided to purchase $400,000 worth of long-dated call options on the stock called MSTR. The expiration I chose was December 19th of 2025. It was about 20 months from the point that I purchased it, and I thought there's plenty of time for this stock to go well beyond the strike price, and it's gonna make a lot of money in the next few years because I think Bitcoin's gonna do well over the next few years. For the next few months, it kind of chopped sideways, if not down, and then after the election, MSTR went absolutely parabolic, and the options contracts also went parabolic. I mean, the stock just went up in a hockey stick pattern. And on November 20th, 2024, and actually I'm recording this on November 20th, 2025, even though I won't post this probably for a month or so, it was worth well over $5 million at the peak. But before I tell you when I sold and why I decided not to sell in that moment, I want to show you the insane math behind options prices and how it's even possible to 12x your money in a few months. So first, what is an options contract? An options contract gives you the right or the obligation to buy or sell 100 shares of stock by an expiration date. Options are confusing, but all you need to know is that there are 4 things you can do with an options contract. Now, you can do different combinations of the 4 and have more exotic derivatives positions, but at its core, you can only do 4 things with options. Okay, here are the 4 things that you can do with an options contract. You can either buy a call, sell a call, buy a put, or sell a put. When you buy a call option, you're buying the right to buy 100 shares at the strike price. Basically, with all 4 of these, you also have an expiration date. You could buy the right to do something in perpetuity that would be worth basically infinity. Every options contract has an expiration date. Typically, they're either a few weeks out, a few months out, and sometimes you can get up to a year or 2 years out as well. When you buy a put, you're buying the right to sell 100 shares at the strike price. Now, if you sell an option, you have the obligation to sell 100 shares at the strike price. And if you sell a put option, you have the obligation to buy 100 shares at the certain strike price. Now, it can be confusing, so this is a better way to look at it. When you buy a call option, you are speculating on the price. And if you are selling a call option, you're basically selling your upside. You're selling speculation to a future buyer. These are also known as covered calls. And if you buy a put option, you're basically buying insurance on your portfolio. And if you sell the put option, you're buying somebody else's downside, and these are known as a cash secured put. Now, if you see my little arrows here, you can see that if you buy a put or sell a call, you're actually buying insurance. And if you buy a call or sell a put, you're speculating on the future price of that certain stock. Hey guys, this is Editor Matt. I forgot to mention which way you are betting if you are buying or selling an option. So this chart does a good job of explaining it. If you buy a call option, you are betting that the price of a stock is going to go up. If you sell a cash secured put, which is in the bottom right of this image, you are also believing that the stock is going to go up because you are buying somebody else's downside. The 2 bearish positions are buying a put and selling a call. Hopefully this explains the bull and bear side of buying options. Again, there are so many ways to mix and match these 4 things to create exotic derivatives positions to match the needs of a certain portfolio. All right, I know that still might be confusing. You can see my little camera rig here, but I am going to show you my example of what it looked like when I bought my stock and how it 12x'd within a few months. And so if you look at this example, now this is not exactly what I purchased because if you know anything about options, you'll know that I'm leaving out extrinsic value. That's something for a different video. We'll touch briefly on it in a second. But let's say I bought 325 contracts of the December 19th, 2025 expiration with a strike price of 380, and it was a call option. So what I'm buying is the right to buy 32,500 shares of MSTR stock on or before December 19th, 2025 at a strike price of 380. That's the price that I'm willing to pay, and I'm purchasing the right to buy that from someone else in the future on or before that expiration date. Now, for this example, let's say the premium is $1,230 per contract. That brings us to our $400,000 example. Now, when the stock price went on its absolutely parabolic rise and it went to $540 a share, 325 of those contracts with a strike price of 380 was worth $5.2 million. And this is the math. Actual share price minus the strike times the number of contracts, and then each contract represents 100 shares. That's how you get to this number of $5.2 million. Now, in a real world example, this options contract would actually be worth even more than $5.2 million because we're leaving out all of the extrinsic value. This is when you get into things like the options Greeks and the Black-Scholes equation. We're not going to go into that. That's a whole nother video. Intrinsic value, basically what your option is worth if it's exercised right now, is easy to determine based on the math. But extrinsic value fluctuates based on the supply and demand of the market for a specific options contract. And stay with me for a second because I know I'm going to lose some of you, but this is really, really important and something that I missed, which is why I lost $5.2 million last year. The one thing you need to know about extrinsic value for an options contract is something called implied volatility. This is a number that's represented as a percentage. It shows you how much volatility the market is pricing for a specific stock on an annualized basis. Now, implied volatility is a tricky number because it tries to represent the entire Black-Scholes equation in one number, and it's different from stock to stock, and it changes every single day. But where implied volatility can be helpful is that when you look at it as a relative number that you can compare to sometime in the past few months, or sometime last year, you can see how expensive or cheap an options contract is depending on what the market is pricing for future volatility. And so if you see on this little chart, a year ago, the implied volatility on MSTR on November 20th, 2024 jumped over 200%. Now, you can't see the left part of this chart. For whatever reason, I cannot find it. Just imagine a hockey stick going to the upside. It was in the 70s to 80s and it went over 200%. Now, since then, you can see the implied volatility has reset lower. It went all the way down to 100, and even recently this year, it got into the 50s and 60s, and now it's elevated again into the 70s. What this means is that to purchase a contract, it is much more expensive when the implied volatility is higher because the market is expecting the stock to continue to move in these highly volatile ways. And it entices the market to sell contracts, to sell calls, and to sell puts into the market. Now, one of the things I did not realize when I owned these contracts on this date a year ago when they were worth, a few $1 million was that the implied volatility was screaming that a peak was in and that you were in a parabolic hockey stick rise. If I'd seen this implied volatility chart, I would have known it was time to sell because that current move was simply unsustainable and you were going to have a crash on the other side, which is exactly what we saw. So on one hand, the intrinsic value of the contracts I owned were going up a lot because the share price was going up a lot. And so that delta between the share price and the strike price was increasing. And so the contracts were worth more. But also on the other side, the extrinsic value of that options contract was also going through the roof because there was more and more demand for it from the market because you were experiencing this epic rise in the stock price. So the market wanted to capitalize and speculate on that price going forward. Okay, we've gone through a lot at this point, and I'm sure most of you are thinking, why didn't you sell? You had $5 million in your account. You could retire and be set for good. Why didn't you sell? Honestly, I'm right there with you. For the last 365 days, I have been wondering that exact same thing. To kind of go back to what I was thinking at the time, I had expected that price action, not in 2024, but in 2025. I expected the MSTR stock to go from the 100s to the $200, $300, $400, $500, maybe even $600, $700, $800 range within the next year, because I assumed Bitcoin was also going to do well within that window. And so when I saw the stock going through the roof, I thought, great, it's going to go even higher. It's going higher faster than I thought, not realizing that that was the peak I expected just way earlier than I expected. And it's also important to remember that I also had duration on these contracts. These weren't weekly or monthly call options. As far as call options go, they were generally conservative from a time perspective. I still had over 13 months left until expiration, so there was no rush to really sell. And on top of that, the strike price I had of 380 was well below the current stock price as it was going into the 400s and the low 500s. And so that also gave a false sense of security that my contracts would continue to be worth a lot going forward. I also, as I just mentioned, didn't really know a lot about implied volatility. Now, in hindsight, you look at this chart and go, it was screaming that there was a blow off top. And I see that now. But at the time, I didn't know about this chart, so I didn't deserve the number that was in my account. Also at the time, I had only held these options for a few months, and the tax on those gains in my state would have been just over 50%. And so I'm looking at, a few $1 million in a brokerage account. The stuff in the retirement account would have been fine, but in the brokerage account, I would have owed over 7 figures in taxes if I had sold. And so I was like, well, I still have duration. The stock price is well above my strike price. I'm going to wait until I hit long-term capital gains so that I pay less in taxes. In hindsight, I should have definitely sold and paid the taxes because you don't have the money later on when the contracts are worth much less. And also too, there's definitely an element of greed. And because I had called it right, I thought the stock would go up, and it went up in a meteoric fashion. My forecast was that it was going to continue to go up in the future. And because I was right once, I assumed that I was going to be right again. And because of that, because these gains were happening sooner than I thought that these contracts would be worth $7 million, over $10 million. And so when greed snuck in, I didn't even think about selling. In fact, I was the most confident in my position when it was at 4.8 or $5.2 million. The moment when I should have been the most concerned and I should have sold. So after the November 20th blow off top for this stock and also kind of for Bitcoin, I just watched my options contract bleed for 3 months straight, day after day, down $20,000, down 50, down 7, down 75, up 10,000. Like it was just this constant grind lower and lower and lower. And as you can see from the implied volatility chart, that was also grinding lower. So it wasn't only the stock price just kind of grinding lower. It was the implied volatility and the theta decay. And there were so many factors going against my options position where basically every single day, even if the stock price went up oftentimes, the contracts were worth less and less. So in February of 2025, I sold for around $700,000, a decline of over $4 million. And I still owed around $150,000 in short-term capital gains taxes because 90 days later, after watching my account bleed over $4 million, I had realized the things we're talking about right now, that there was a blow off top. The implied volatility was screaming that this was a very big impulse. The incentive for everybody in the market, including the company itself who was selling shares, was to sell, whether they owned options or shares. So after watching it bleed for 3 months, I decided to sell, pay the taxes, and then reevaluate my investing landscape. And honestly, it's been a very tough mental situation to deal with. $700,000 is great. A $300,000 gain, it's terrific, obviously, and you pay a few $100,000 in taxes, but seeing a big number that you could have had and dreaming about the things you could have bought or the freedom you could have secured for yourself and then losing it in the matter of 3 months, it's kind of a difficult thing to deal with mentally. And I come back to this verse in the Bible, Proverbs 13:11, that says, "Wealth gained hastily will dwindle, but whoever gathers little by little will increase it." I gained that money in my account, the paper gains, very hastily, very, very quickly. And so I didn't appreciate even the little amounts that I was gaining or large amounts I was gaining every single day. And therefore, I didn't try to capture or protect it. I was literally playing with house money. And so when I lost $100,000, if it went from 4.8 to 4.7, it didn't really affect me that much. When now, if I lost like $100,000 of money I've worked for, that would definitely leave a big impact on me. But the money was gained so quickly that I didn't really have the emotional connection to it or the wisdom to take care of it in a manner that I should have. And so after this trade, and also a few other trades where I made a lot of money and lost a lot of money on a smaller scale, I've stopped trading options. I no longer trade options. When you trade options contracts, there is a lot of stress. You can lose a lot of money in a very quick period of time. There's a lot of greed and hubris. There were many nights where I was up in bed. I was stressed out. I couldn't sleep. I was doing, I pulled up options calculators on my phone and I was, running numbers in my head that if the stock reached this point or if it dropped to this point, this is what the options would be worth. How can I make back money that I had lost? Which is the basic mentality of a problem gambler. And options are also very tricky too, because you could be right. If you think a stock, you owned Apple stock at $100 and you thought it was going to go to $200, you could be right about the final destination of that stock. But are you right about the immediate direction and duration of when that happens? You not only have to be right about the stock price, but you also have to be right about the timing. And that's basically impossible. If you are going to trade options, you should know that it is a trade. It's not a substitute in your portfolio for a long position, unless you are intentionally sizing it very small with a lot of intentionality around the expiration. Now, having knowledge of options can be very helpful for investing because you learn more about what drives financial markets. You learn about broker dealers hedging their risk portfolios. You learn a lot about income and hedging strategies with options. However, trying to trade options, especially in a speculative manner to make a lot of leveraged money, is a great way, trust me, to incinerate capital. I think too, one of the illusions that I fell into was this greedy clown when I would put numbers into an options profit calculator and I would see that these options would be worth $10 million, $20 million if the stock would go to a price that's literally not possible or sustainable. And so for myself, I've learned that greedy part is acting against the things that are best for me from a long-term investment perspective. And from that, I have a better perspective on luck and risk. In this situation, I experienced a tremendous amount of luck, which at the time I thought was, knowledge and expertise, but it was really luck. I got very, very lucky, which let my portfolio grow 12x. But on the other side of that luck, I experienced risk. The risk of a stock going down when you think it's going to go up. The risk of buying or holding a call option when implied volatility is plummeting through the floor. And like my favorite author Morgan Housel talks about, when you have a proper understanding and a proper respect for both luck and risk when it comes to your investing portfolio, you realize how little you actually control and how little you really know about markets. So since this happened, it's definitely changed my perspective on investing and what I do with my money going forward. I don't trade options anymore. And if I pick a certain stock, I spend a lot of time on it and know that it's a 10, 15, 20 year investment where the odds are that I'm going to experience risk to the downside and I could lose the money that I put into that stock. That's why a lot of my money is, I know it's cliche, but in index funds. And I do own some Bitcoin in a brokerage account. And I do want to pay off my mortgage before 30 years is up to kind of mitigate the risk. Now, these may seem like extreme measures for someone who probably just chose a bad trade and didn't go long in a very prudent manner. And let's be honest, even though I've shared all these things, this whole video is just cope. I'm mad that I lost $5 million.